All right, welcome to this explainer. Today, we are going to look at the economy not as some boring series of charts and numbers, but as a giant, roaring engine. And we're about to give you X-ray vision to look right under the hood. We are going to completely demystify the macro economy by looking at two absolutely massive forces, aggregate demand and aggregate supply.
Now, to see why this actually matters, we don't have to bury our heads in a textbook. We can just look out at the real world. Take Vietnam, a true rising star in Southeast Asia. Since the mid-'80s, Vietnam's economic engine has been running hot, with output growing by over 6% a year, every single year, on average. And hey, this isn't just some abstract mathematical number. This growth literally transformed everyday lives, boosting average incomes from just $320 in 1985 to over $2,300 by 2019. So how does a country achieve that kind of balanced, sustained growth? Well, that's exactly what we're going to figure out today.
Okay, let's dive into this. Here is our roadmap. We'll start with the economic engine explained and the 4 pillars of spending. Then the aggregate demand curve, shifting the demand, understanding aggregate supply, and finally, the long-run reality. By the end of this explainer, you are going to be able to decode the secret language of global economists.
Starting right off with Section 1, the economic engine explained, where we look at understanding total spending.
So, if the economy is an engine, then aggregate demand is basically the fuel that powers it. Without demand, nothing moves. And hey, the word aggregate just means total. So, aggregate demand, or AD for short, is simply the total spending in an economy over a period of time. It has this master formula that economists use to calculate it. AD equals C plus I plus G plus X minus M. I know, formulas can look a little intimidating right off the bat, but don't worry. We're going to break down this formula step by step so it makes perfect sense. Moving right along to Section 2. The 4 pillars of spending. This is where we deconstruct that demand.
Now, what's really interesting about this slide is seeing how different countries rely on entirely different pillars to fuel their economies. Look at Pakistan. A massive 80% of their aggregate demand is predicted to come from regular consumer spending by 2025. Compare that to China, where consumer spending is only 40%, but investment is a towering 43%. Every nation really does have its own unique mix. So let's look at what each of these letters in the formula actually represents in the real world. First step is C for consumer expenditure. This is literally just you and me buying groceries, grabbing movie tickets, or shopping for clothes. The biggest factor here is disposable income, what you actually have left in your pocket after taxes. But there's also the wealth effect. If the value of your house or your shares goes up, you just feel richer and you're likely to spend more, even if your actual paycheck hasn't changed one bit. Plus, when interest rates drop, borrowing gets cheaper and people tend to spend a lot more. Next is I for investment. And actually, scratch that. Don't think about buying stocks here. In economics, this means private businesses spending on capital goods. Think brand new factories, massive machines, or a fleet of delivery trucks. This pillar relies incredibly heavily on business confidence. If companies expect future sales to be strong, they expand. It also depends on the cost of borrowing. Lower interest rates mean it's way cheaper to finance that new factory.
Our third pillar is G for government spending. This covers the whole shebang of what a government provides for the public. It includes merit goods like schools and healthcare, public goods like national defense and street lighting, and major infrastructure like power plants and bridges. This kind of spending is driven by government policy, the amount of tax revenue they manage to collect, and even demographics, like, say, needing to build more schools for a rapidly growing youth population.
The final pillar is net exports, which is exports minus imports, or X minus M. Exports bring money into the country when foreign buyers purchase our domestic goods, while imports leak money right back out when locals buy foreign goods. A country's global competitiveness, meaning the price and quality of its goods, and its exchange rate are huge factors here. A lower exchange rate just makes your exports way cheaper for the rest of the world to snatch up at the global ports.
All right, into Section 3, the aggregate demand curve. Let's look at the actual mechanics of price and spending. So we have our formula, C plus I plus G plus net exports. But when we graph that aggregate demand against the general price level, the curve slopes downwards from left to right. Now, you might be wondering, why? It's not the exact same logic as a normal demand curve for just a single product, like a cup of coffee. There are 3 specific macroeconomic reasons. First, the wealth effect. Higher overall prices across the board reduce the real purchasing power of your savings, making you feel poorer, so you spend less. Second, the international effect.
If our domestic prices rise, our exports become more expensive for foreigners, and foreign imports look cheaper to us locals, so net exports shrink. And third, the interest rate effect. Higher prices mean people literally need more cash on hand to buy things, which drives up the demand for money, pushing interest rates up, which in turn chokes off borrowing and spending.
Section 4. Shifting the demand. Let's talk about shocks to the system.
So what happens when non-price factors completely shake up the economy? And this brilliantly illustrates a absolutely crucial difference: understanding a movement versus a shift. A change in the general price level, that just causes a sliding movement along the existing curve. But if literally any non-price factor changes, say a sudden massive burst of consumer optimism or a huge new government infrastructure project, that causes a total shift of the entire curve to a brand new position.
Basically, any non-price factor that increases total spending pushes the entire curve to the right, which signifies economic growth. So if the government slashes taxes, leaving people with way more disposable income, or if business confidence just skyrockets, bam, the curve shifts right. Conversely, if there's a pessimistic outlook, higher interest rates, or raised corporate taxes, that's going to shrink total spending, pushing the entire aggregate demand curve to the left.
Okay, let's flip the script. Section 5, Understanding Aggregate Supply, which is all about the engine's physical capacity. Up until now, we've really only looked at the buyers. Let's move over to the producers and see how this builds a complete picture. On one side, you have your household shoppers and total demand. But on the other side, you have the massive industrial power plants and factories required to actually supply them. Aggregate supply is the total planned output of goods and services produced by firms in a country.
Now, in the short term, we look at the short-run aggregate supply, or SRAS. This curve slopes upwards, meaning producers are going to supply more as prices rise. Why? Well, primarily because of the profit effect. In the short term, input costs like wages haven't adjusted yet. They're kind of sticky. So if the price of goods goes up, profits increase, which obviously encourages more production. There's also the cost effect, where cranking up output requires overtime pay, necessitating higher prices to cover those extra costs. Finally, there's the misinterpretation effect. I love this one. It's where producers see their product's price rising and mistakenly think their specific item is uniquely popular, rather than realizing it's just general inflation happening everywhere.
And you guessed it, just like demand, the supply curve can shift entirely based on non-price factors. Imagine a sudden natural disaster that wipes out key resources. That instantly drops the quantity of available resources and shifts supply to the left. But on the positive side, massive leaps in technology that improve factor productivity, or a government cutting corporation taxes, will instantly expand a nation's immediate production capability, pushing that supply curve right.
Finally, Section 6, the long-run reality, taking the Keynesian view.
We've looked at all these short-term shocks, but let's zoom all the way out for a second. This brings us to the long-run aggregate supply curve, specifically looking through the Keynesian view. This perspective brilliantly points out that economies don't always run at maximum redline capacity. At low levels of output, when unemployment is high, an economy actually has a lot of what we call spare capacity. This acts as an incredible economic buffer. It means firms can hire more workers and increase production to meet rising demand without triggering massive inflation. Wages and input costs just don't shoot up immediately because there are plenty of available workers and idle resources just waiting to be used.
So the absolutely crucial point here is that understanding where your country sits on this curve tells you a whole lot about its future. Which leaves me with a question for you to ponder. Take a look at your own national economy today. Does your country currently have that spare capacity to grow gracefully? Or is the economic engine already running at its absolute limit, where any more spending will just trigger higher inflation? Think about that next time you read the news. Thanks for joining me on this explainer, and keep looking for the forces moving the world around you.